Chris Marks here with McLean Mortgage. Just wanted to share a really quick timeline. I've been getting a lot of questions lately on what's going to happen in the market. And while we typically really don't know what's going to happen in the market, there are some factors that we need to take into consideration because people are telling me, oh yeah, the market's going to crash, I'm going to wait, I'm going to wait, and I'm going to wait. Well, that's certainly something you can do, but I'm going to kind of share a timeline of what I think has happened in the past and why we're not going to see the repeat of 2009 again. So I'm just going to kind of share that. This is definitely not a political statement whatsoever. It does involve some politics because the politics did influence the outcomes of certain times, but this is not a political statement whatsoever. So to understand today, which is all the way over here, we actually have to back up to 1998 when Bill Clinton instituted a great program. It had great intentions. Unfortunately, it actually created the crash of 2009 where he was trying to, in essence, open up affordability to homes to everybody and reduce segregation. While that was a great idea and while that was a fantastic idea, what that ended up doing is create the debacle that we had in 2009. Because what ended up happening here is we started seeing people coming into the market and we started seeing a huge uptick in people. But the problem is that during this time, we also saw the rise of the adjustable rate mortgage, which came into play during this time. And it was actually extremely significant because it opened up a lot of opportunities. But there was no legislation at that point in time to control the financial markets and make sure people had what we now have, which is called the ability to repay. What ended up happening with this is that we saw the adjustable rate mortgage come in and we saw reverse amortization mortgage. We saw resetting mortgages that happened at a crazy time frame. And so once mortgages started happening, and they really didn't have to worry about the ability to repay at that point in time, there wasn't the financial requirements that we have now to verify your pay stubs, verify your assets, verify your work history, verify your ability in essence to repay this loan. And so what that created was a huge, massive surge right up here. And we started seeing people just buying homes like crazy things. I remember at the time I was actually working for a builder and we got to see a lot of people coming into the market and just doing all sorts of great things because the home appreciations were going up. People were trying to buy homes as if they were investments, not necessarily shelter and dwelling for the family. And so that created a huge peak. And we saw this thing come up all the way over here. And then in 2008, we started seeing it come down. And 2009 was when the crash actually happened. And that was a very significant crash, but the crash happened because they tried to loosen up the standards for lending to let everybody in, not necessarily taking into account that they had to prove the ability to repay. And we created a huge problem because of how finances were being structured and how the paper, they call it paper, but how the loans were being written. Take that to 2009, and we had a massive crash that happened in between 2008 2009. While the economy started coming down, we started seeing things really coming down. 2010, right about here in 2010, we saw the Dodd-Frank bill come in. And the Dodd-Frank bill, what that did was actually create what they should have had back here underneath these arms, underneath this wonderful intention that they had to help open up housing for everybody. They didn't have the Dodd-Frank bill, which was to protect the consumer from predatory lending practices. And so what ended up happening back here is that now all of a sudden, in this crash right here, believe it or not, but 10% of America lost their home. That's a massive number. 10% of America lost their home. Now I'm rounding up because I'm in sales, but in essence you get the picture. A lot of people lost their home. At the same point in time, the Dodd-Frank bill, because everything goes in pendulums where you swing one way and then you swing the other way, the Dodd-Frank bill, what it actually did was it also, not only did they lose homes, but it also created a credit crunch. And this credit crunch, what it did was it made it very difficult to be able to buy a home. I remember I bought my first home back over here in 1996. All I needed was one pay stub and my social security number. Well, the Dodd-Frank bill instituted the three words, ability to repay. And with this ability to repay, now we're asking for pay stubs. Now we're asking for bank statements. Now we're talking about how to calculate income with the most conservative approach. Well, this got worse and worse and worse and worse until it probably bottomed out somewhere right around 2013, 2014, somewhere in there. But it didn't come up very quickly. It actually just restarted recovering very, very, very slowly is what ended up happening. And we started seeing a little bit of a recovery to where we finally were breaking even on homes somewhere right around 2018. Well, 2020 rolled around, so now we started seeing some significant appreciation right up here in 2018. And during this time, this credit crunch wasn't just for consumers. This credit crunch was also for builders. They couldn't build homes between this period of time. They were having a hard time getting the financing and the funding in order to be able to make this timeline work and actually build homes, to the tune that during this time frame, an entire decade, they were short 1 million homes per year, which you multiply that by 10, and now we are 10 million homes short during this decade. But there's another thing that also happened during this time too, is that we had people starting to recover only to find out that the banks had not foreclosed when they said they did back here, and getting the zombie mortgages coming back to bite them because they had turned in the keys, thought they were all clear, and then now all of a sudden they're trying to buy a home and they can't buy a home because in essence their foreclosure just happened. Big, huge deal. At the same point in time, we had immigration happening that was pretty much out of control. And there were a lot of things happening in this time frame. Now, they tried to fix a lot of these things. This is certainly not political statements, but this is just kind of what happened during this time frame. Now, coming back into 2018, we're 10 million homes short. Already, 1 decade later, 10 million homes short. At the same point in time, we've had a lot of immigrants come into this country. At the same point in time, we've got 10% of America who is now requalified to get back into housing. You fast forward and we start coming into this little period of time called 2020. And everybody remembers that fun pandemic time that hit. Well, during that pandemic, they did something in Congress to actually try to keep America running, which is they lowered the interest rates and they started stimulating the economy. Two things were really good idea at the time because America was suffering. People were having a hard time going to work. We had a massive pandemic that were killing thousands of people. They had to do something. Now, having said that, the unfortunate sidebar of this is it created an incredible boom. In 2020 and 2021, we saw housing prices go crazy because now we're having that 10% of America is back in the market. We have immigration, okay, coming in. And we also have 10 million homes short. So now there's competition at all sorts of crazy levels over here with homes going in, with homes coming out, with things happening. And all of a sudden, all these bills from 2020 to present, right up to over here, are now starting to come due. All the giveaways that we had back here in this time has now created inflation that is pushing things out of control. Now, the synthesis behind this, and this is not something that I've come up with, you can actually find this online in several different places, but the synthesis that I've come up with this is kind of what the economists are saying. The economists are saying that this right here is making up for these downtimes that we had down here in 2008 through 2018. Now, the other side of this is that as we start coming out of this period in time, not only are we seeing the low rates, we had extremely low rates. To get back to these extremely low rates of 2s and 3s, we're going to have some sort of a pandemic, some sort of a problem that is going to be global in nature to bring us back to these rates. Back when I bought my home over here, in 1998, I was at 8.5% interest. Right here, right back here, 8.5% interest. Today, we're at over 6% interest. We're still in a much better place than where we were. But now what about housing prices? Because of the people getting back into the market, because of immigration, because of the shortage from the builders, this demand is going to continue. You're not going to see a dip even though the interest rates are going up. Things are going to slow down, but you're not going to see a dip. So this is where demand is going to still trump the rate hike. We may see it slow down a little bit, but I doubt you're going to see the same thing that we saw over here as far as in this little bubble. Anyway, hope this is helpful for you. Just wanted to make sure that I shared with you some great information to help you make some decisions out in the market. These are some important things to keep in mind. Just keep in mind that nobody has a crystal ball. This certainly was not a political statement. This is just a statement of what's happening in the market and a synthesis of what I'm hearing the different economists say. Hope all is well. Don't hesitate to call if I can be of help.